Okay, welcome to the deep dive. Today we are plunging headfirst into, well, the intense pace of change happening right now in U.S. digital asset regulation and legislation. We're talking early to mid-2025, and things have been moving fast across Washington.
That's absolutely right. Our goal here is really to take this stack of recent articles, research, reports, all the source material, and just pull out the most important insights for you. We want to give you a clear picture of what's shifted, at the IRS, the SEC, in Congress with stablecoins, and even new conversations happening at the CFTC.
Think of this as your essential briefing on the latest regulatory landscape. We'll cover those IRS reporting tweaks, the SEC's fresh take on classifying tokens, some genuinely significant legislative steps on stablecoins.
Yeah, really big ones there.
And finally, a peek into the regulatory considerations for crypto derivatives and that whole challenge of 247 trading.
Okay, let's unpack this.
Right. Let's start with something specific, but pretty impactful for some corners of the market. IRS reporting rules. There was a notable action on April 10th, 2025. President Trump signed some legislation. What did that specific bill actually do?
Yeah, this was quite targeted. The legislation specifically nullified certain digital asset reporting obligations. These were ones originally placed on certain types of brokers under Section 8603 of the Infrastructure Investment and Jobs Act, the IIJA.
Okay, certain brokers. So who exactly was this repeal, intended to help or exempt?
It primarily zeroes in on decentralized finance, or DeFi brokers.
Yeah.
And crucially, these are the entities operating almost entirely on the blockchain infrastructure itself. They don't provide those traditional on or off ramps between, fiat currency and digital assets.
Got it. So for those specific DeFi entities, they are now not required to file Form 1099-DA or collect Know Your Customer KYC information, at least not under that specific repealed rule.
Exactly. The reasons cited for this action in the sources, they often highlight concerns that the original broader rules were just impractical for these permissionless blockchain protocols, that they could stifle innovation in DeFi.
Okay, but here's where it gets really important because, like you said, it was targeted. This wasn't a full repeal of all crypto tax reporting, was it?
No, not at all.
So what are the critical parts that still remain in effect?
Right. The biggest point is that information reporting obligations absolutely still apply to centralized exchanges. These are, the platforms that hold crypto for customers, the ones offering those fiat on-off ramps most people use.
Good.
They will begin issuing Form 1099-DA to their users in 2026. That's covering transactions from January 1st, 2025 onwards. And look, many have already been putting in or expanding their KYC processes anyway, getting ready for this.
And it's not limited just to those big centralized exchanges, right?
Correct. Reporting obligations also remain for digital asset payment processors and for entities that, regularly issue and redeem their own tokens. Beyond that specific rule change, the IRS's broader enforcement priorities when it comes to digital assets, well, they haven't changed.
And maybe the most crucial takeaway for you, the listener, as a taxpayer, what's the bottom line?
Your fundamental responsibility. It's completely unchanged. You are still responsible for accurately reporting all your digital asset gains and losses, period. And the IRS's stance against that universal wallet accounting idea, which they clarified in Revenue Procedure 2024-28, that position is also unchanged.
Meaning you can't just lump everything together.
Exactly. You need to track the cost basis of the specific assets involved in your transactions.
So the core advice hasn't really shifted, even with this specific repeal for some DeFi folks.
Not really, no. The key insight here is, look, while a narrow slice of the market got relief from one specific reporting rule, the vast majority of digital asset users, especially those interacting with centralized platforms, you're still subject to these reporting requirements.
So keep good records.
Absolutely. It strongly reinforces the need for you to maintain detailed records, use tools that help with proper basis tracking, transaction reporting. Remember, activity on public blockchains is, well, public. The audit risk hasn't just vanished because one rule got tweaked.
Okay, shifting gears from tax rules to classification debates, the SEC has been active too. The SEC's Division of Corporation Finance, CorpFin they call it, released a pretty comprehensive statement, also on April 10th, 2025.
Yeah, they did.
What was the SEC aiming for with this guidance? Were they finally giving us like a definitive list? This is a security, this isn't.
Well, not quite a definitive list. The stated goal was more about reducing ambiguity around how crypto tokens get classified under U.S. securities laws. And, importantly, providing an updated interpretation of the Howey test specifically for crypto. It's really aimed at helping companies, offering or registering crypto assets, understand how CorpFin views disclosure requirements and that potential securities classification.
Right, the Howey test. Just a quick refresher for everyone, that's the classic four-part framework, right? Investment of money.
Expectation of profit, a common enterprise, and reliance on the efforts of others.
It's nice.
So what was the SEC really emphasizing in this TUM 25 guidance?
They put significant weight on that reasonable expectation of profit prong. The key insight seems to be this. If buyers are expecting profits based primarily on the efforts of a centralized team or promoter, the SEC is highly likely to view that token as an investment contract and therefore a security.
They explicitly quoted something like, where entrepreneurial efforts drive price appreciation, token holders effectively invest in a common enterprise. So that common enterprise part in this context often hinges on whether the token's value is tied to the success of the promoter's work.
They also laid out a kind of framework for evaluating tokens, didn't they? A three-pronged thing.
Yes, it's a practical lens. First, look at the initial sale context. How was the token marketed? Was it pitched like, buy this, get rich? Second, what's its ongoing use? Does the token actually do something functional on a decentralized network beyond just speculation? And third, issuer influence. How much control does the founding team or foundation still have over the project?
Okay, so based on the sources, let's run through some examples. What kinds of tokens are likely to be seen as securities under this framework?
Pretty much anything that smells like a traditional investment contract, Tokens sold with clear promises of profits driven by a central team's work. ICOs marketed mainly on profit potential. Governance tokens that offer dividends, revenue sharing, or some claim on protocol profits.
Even utility tokens.
Yeah, even utility tokens if their value is heavily promoted based on expected appreciation or financial benefits, rather than just their immediate use. And look at the legal precedents, right? The LBRY case ruled an unregistered security. The institutional sales part of the Ripple case deemed securities offers. Those give strong clues about the SEC's thinking.
So if it's centrally controlled, maybe pre-mined, pushed mainly for its price going up, and doesn't really do much useful at the time of sale. Sounds like the SEC sees it as a security.
That's certainly the direction they seem to be pointing. Now, what's not likely to be considered a security?
Okay, yeah. What's on the other side?
Well, the guidance suggests things used strictly as tools or goods, where the main reason for having it isn't making money. Think in-game items you actually use, digital access keys, non-transferable loyalty credits, that sort of thing.
And stablecoins.
Specifically, fiat-backed stablecoins that are genuinely 1.1 backed by transparent, audited reserves designed purely for payments and not marketed as investments. Those generally seem to fall outside the securities net under this guidance.
What about things like Ether or Solana? Layer 1 utility tokens.
Right. If they're used for fundamental network operations, paying gas fees, staking for validation, and their value is fundamentally tied to the health and use of the network itself, rather than promotional efforts by a central team, they're less likely to be classified as securities. Same goes for projects that are genuinely community-driven, open source, with truly distributed control, where the token acts more like a digital tool for that network.
But there are definitely still gray zones here, aren't there? It's not all black and white.
Oh, absolutely. Tokens that kind of look like both tools and investments. Governance tokens are a classic example. Maybe your vote influences protocol income or staking rewards, so holding the token benefits you if the protocol succeeds financially. That gets tricky.
And DeFi and DAOs.
Yeah, huge complexities there. When does a decentralized project still look enough like a centralized company for the SEC? Does having a voting token automatically mean you're not dealing with a security? It really highlights the need for careful legal analysis. But getting a definitive public answer from the SEC, like a no-action letter, that's still very rare and super specific to the facts.
So, practically speaking, what are the implications of this guidance for the industry, for issuers?
For issuers, it's definitely a call to action. They need to seriously assess their token's characteristics, how they market it. It might push some to register, or maybe even redesign their projects to really emphasize utility and decentralization, steering clear of investment-like features and the risk of not complying. It's significant penalties, getting delisted from platforms, you name it.
And for investors, people listening?
Well, it could mean a cleaner market, potentially. Fewer outright scams, maybe, posing as unregistered securities. But on the flip side, it might also limit access to certain tokens, especially those highly speculative projects offering quick profit potential.
What about the exchange?
They'll likely implement stricter listing standards, do more rigorous legal checks, probably provide clearer risk warnings to users.
Mhm.
U.S. exchanges will probably continue to be cautious about listing tokens that look like they might be unregistered securities. And this also raises that possibility. Exchanges dealing heavily in tokens deemed securities might eventually need to register as securities brokers or alternative trading systems, which is a whole complex, costly process.
How did the industry react to this guidance? Was it welcomed?
Reactions were mixed, as you'd probably guess. Some legal folks found it helpful, saying it clarified CorpFin's thinking, especially around disclosure needs. But many in the crypto industry, they worried that the heavy emphasis on expectation of profit and issuer control could stifle innovation, that it might mislabel genuinely decentralized projects based on, subjective factors.
Right, you heard arguments about things like airdrops, for instance.
Yeah, exactly. Like from Coinbase, arguing that just doing an airdrop shouldn't automatically make something a security if it's not really about fundraising based on a company's efforts.
And this ties back to that broader critique we often hear about the SEC's approach, regulation by enforcement.
Precisely. Commissioner Hester Pierce, for example, has consistently raised this point. Relying on enforcement actions and guidance like this, rather than clear, upfront rulemaking, creates a lot of legal uncertainty. It makes it really tough for startups to figure out how to comply proactively. The SEC sees it as applying consistent investor protection principles, but critics argue it hinders legitimate development by keeping everyone guessing.
And how does this SEC approach this sort of case-by-case, Howey test-driven thing compare to what's happening elsewhere, like the EU's MiCA framework?
It's a fundamentally different philosophy, really. The SEC uses the adaptable Howey test, applied through enforcement and guidance, vary facts and circumstances. MiCA, in contrast, is rules-based. It creates specific categories for crypto assets, utility tokens, asset reference tokens like stablecoins, e-money tokens, and sets clear, upfront requirements for licensing, capital operations, disclosure for each type.
So MiCA doesn't start by assuming everything might be a security.
Right. It builds a distinct regulatory structure specifically for crypto, focusing on consumer protection, market integrity, and especially stablecoins, putting them into defined buckets with specific rules from the get-go.
Okay, speaking of stablecoins, while the SEC guidance touched on them, this area seems to have seen maybe the most significant legislative progress recently.
Yeah, some really big moves in Congress. Back on April 2nd, 2025, the House Financial Services Committee advanced 3 digital asset-related bills.
Right, that included the Stable Act, the Financial Technology Protection Act, and the Anti-CBDC Surveillance State Act.
Yeah.
And the stablecoin one, especially, got bipartisan votes coming out of committee, which was notable.
It was. Chairman French Hill specifically highlighted the Stable Act, calling it a product of bipartisan work and emphasizing the need for guardrails, not roadblocks for innovation.
But the really big news, perhaps, came from the Senate.
Absolutely fascinating development there. On May 21st, 2025, the U.S. Senate actually broke a filibuster on S-1582, the Genius Act of 2025. The vote was 66-32. That's a significant margin, sending the bill to the full Senate floor for consideration.
Breaking a filibuster on a crypto bill. That's a major signal, isn't it? The Genius Act is being called the first comprehensive federal framework for stablecoins. Who's behind this push in the Senate?
It's got strong bipartisan backing. Lead sponsors include Senators Gillibrand, Haggerty, Scott, Lummis, also Brooks, a real mix. And their stated goals. They echo the House. Provide regulatory clarity, encourage innovation to stay here in the U.S., protect consumers, and importantly, reinforce the U.S. dollar's global role by properly regulating USD-denominated stablecoins.
Okay, let's dive into the details. What are some of the key provisions of this Genius Act, based on the sources?
First, it clearly defines what a payment stablecoin is. A digital asset for payment or settlement, redeemable at a fixed amount, like $1. A critical piece is the reserve requirement strict 1.1 backing with specific permitted reserves.
Not just any assets.
No, the list is pretty narrow. Actual coins or currency, insured bank deposits, very short-term U.S. treasuries, specific types of repo agreements, government money market funds, central bank reserves, and maybe other assets regulators specifically approve. And crucially, those reserves can only be used for redemptions and related collateral needs. Nothing else.
So that's a core protection, ensuring the stablecoin is actually stable.
Absolutely. The bill also mandates tailored rules from regulators federal and state covering capital, liquidity, and risk management for issuers. Importantly, it exempts stablecoin issuers from traditional bank capital standards, acknowledging they're not the same as deposit-taking banks.
What about transparency, disclosure?
Key focus. Issuers must clearly establish and disclose their redemption procedures. They need to provide periodic reports on their reserves, certified for accuracy. And a large issuer is defined as over $50 billion in circulation need full annual audits.
And it seems to pull stablecoin issuers firmly under the existing financial crime prevention umbrella, like BSAKL.
Yes, definitely. Issuers would be subject to the Bank Secrecy Act. FinCEN would be tasked with writing specific rules, including tackling how to detect illicit activity using potentially novel digital asset systems. Issuers have to certify they're complying, and there are rules preventing individuals with certain financial crime convictions from being officers or directors.
Who would actually be allowed to issue these payment stablecoins under the Genius Act? Is it just banks?
No, it allows for both banks and credit unions, maybe through subsidiaries and non-bank entities, to become registered issuers. Both types would need to register with a federal regulator. There's also an interesting provision for smaller non-bank issuers, under $10 billion. They might be able to operate under just a state regulatory regime if the heads of Treasury, the Fed, and the FDIC collectively determine that the state's rules are substantially similar to the federal ones.
What about stablecoins issued outside the U.S.? Can they operate here?
The bill generally restricts the offer or sale of stablecoins in the U.S. within 3 years to only these permitted registered issuers. However, it does create a path for the Treasury Department to make agreements with other countries, other jurisdictions, that have comparable regulatory regimes.
Ah, okay. Reciprocity.
Sort of. Foreign issuers from those qualifying jurisdictions could potentially be traded here and interoperate if they register with the OCC, submit to supervision, and crucially, hold sufficient reserves in the U.S. to back redemptions originating here.
Any other significant provisions worth mentioning?
A few, yeah.
Yeah.
Stablecoin holders would get priority in bankruptcy proceedings. That's a notable protection.
Mm.
The bill explicitly states that payment stablecoins regulated under this act are not securities or commodities. That's huge for regulatory certainty.
Right, avoids the whole SEC, CFTC fight.
Exactly. And it clarifies they are not federally insured like bank deposits. Some things mentioned in the sources that might still be debated include a potential ban on stablecoins that offer yield and possibly restrictions on very large tech companies becoming issuers.
This legislative energy, especially the bipartisan push on Genius, it feels very much aligned with shifts we seem to be seeing among the federal banking regulators themselves. Is there a connection?
There definitely seems to be. There's been a noticeable change in tone among the OCC, the Fed, the FDIC under the new administration. Remember that period where the industry felt the regulators were putting up roadblocks? Like that January 2023 joint statement warning banks about crypto risks, or the FDIC sending pause letters to crypto firms looking for deposit insurance.
Yeah, a lot of frustration then.
Right. Now, the sources suggest a move towards maybe broader openness, at least allowing banks to engage in certain blockchain and crypto activities, provided the risks are managed.
The whole saga with SAB 121 seems like a perfect example of that tone shift, doesn't it?
It really is. That SEC staff accounting bulletin from March 2022. It basically forced banks holding crypto in custody for customers to put those assets on their own balance sheets as liabilities.
Which made custody super expensive from a capital perspective.
Exactly. It significantly increased the capital required, making it very difficult, almost impossible, for many banks to offer crypto custody at scale. Congress had actually passed a resolution disapproving it, but that got vetoed by the prior administration. Now, with this different regulatory climate, SAB 121 has been rescinded. That's a huge deal for banks wanting to offer custody services.
We heard that term debanking a lot. The industry feeling crypto companies were being unfairly shut out of basic banking. Regulators, of course, countered that banks could serve crypto clients. They just needed to manage risks like BLL properly.
That tension was very real. You had the industry feeling ostracized, denied basic accounts, while regulators were, understandably, focused on safety and soundness, especially anti-money laundering concerns. And this is where some recent industry advocacy gets really interesting.
Coinbase wrote to the OCC, didn't they, asking them to confirm banks are allowed to do crypto custody and partner with third parties for it.
Yeah, they pointed directly to the OCC's own guidance from late 2021 Interpretive Letter 1179, which had sort of green-lighted custody but often required a supervisory non-objection letter, which the industry felt just wasn't being granted easily, creating a bottleneck.
But what's perhaps even more telling, and maybe the key insight into this whole shifting landscape, is the letter from the big traditional finance groups.
That's the fascinating part. You have groups like the American Bankers Association, the Bank Policy Institute representing the biggest U.S. banks, writing directly to the White House Special Advisor for AI and crypto, and their ask was significant.
Oh, they want.
They requested a comprehensive review and potentially rescission of all federal banking agency policies that they felt were hamstringing banks, preventing them from participating more fully in digital assets. And tellingly, they asked for the banking agencies themselves to be formally added to the White House's crypto working group.
Wow. What stands out to you about those letters, especially the one from the traditional banks? Why is that such a big deal?
I mean, this is a fundamental shift in posture. You have the largest players in traditional finance explicitly saying, we want in. We want to do crypto custody. We want to engage in these activities. And they're not just asking regulators for clarity. They are essentially allying with crypto firms in pushing back against perceived regulatory barriers.
Right.
That's a major political and industry dynamic change compared to just a year or two ago. The big banks aren't just watching cautiously from the sidelines anymore. They want a piece of the action, and they want the rules to clearly allow it.
And that sense of openness might even extend to allowing new banks, de novo banks,
Right.
with innovative crypto-related business models, something that was incredibly difficult to get approved previously. Even specialized firms like Anchorage faced hurdles.
Exactly. And just to add a bit more context to the stablecoin discussion, Federal Reserve Governor Waller gave a speech back in February 2025 that's also pretty insightful here. He laid out several stablecoin use cases he saw as potentially valuable.
Like what?
Things like a safe way to store value within the crypto ecosystem, a way for people to access and hold U.S. dollars perhaps without needing a traditional bank account, cross-border payments, maybe using that stablecoin sandwich idea where you swap fiat for stablecoin, send it globally, then swap back.
Right. Potentially cheaper and faster.
Potentially. And maybe even limited use in retail payments down the line. He also touched on the business models for issuers earning interest on the reserves, charging transaction fees, or maybe using the stablecoin as a loss leader to bring users into their broader platform.
But he also highlighted the challenges, didn't he? The need for regulation.
Oh, absolutely. He was very clear on the risks needing robust regulation, safety and soundness of the issuer, managing the potential for bank run-like redemptions, and mitigating any risks stablecoins might pose to the wider payment system if they grew large enough.
And he talked about fragmentation.
Yes, he particularly stressed the problem of fragmentation. Not just technical fragmentation, different stablecoins not working together, but especially regulatory fragmentation. He pointed to the confusing mix of global regimes like MiCA in Europe versus various state-level frameworks popping up in the U.S., often with conflicting reserve requirements and rules.
And his conclusion on that.
This lack of consistency is a major barrier. He argued that a clear, consistent federal framework is really necessary if stablecoins are going to achieve significant scale and utility, particularly as a payment tool. And maybe just as importantly, he argued that having such a framework is key for the U.S. to position itself as the regulation setter for the rapidly growing global market in USD-denominated digital assets, maintaining that influence.
Okay, let's shift gears one last time. Let's talk derivatives and the unique world of 247 crypto trading. The CFTC comes into play here. The Digital Chamber, TDC, has been active recently engaging with the Commission.
That's right. They submitted 2 comment letters to the CFTC just recently on May 21st, 2025. This was in response to the CFTC asking for public input on these evolving market structures.
What was TDC's overall message or goal with these submissions? What were they pushing for?
They're basically advocating for the CFTC to adopt a modern principles-based approach to regulating digital asset derivatives. An approach that can embrace the unique aspects of crypto innovation like that 24/7 trading while still making sure market integrity is preserved and customers are protected. The usual core goals.
Okay, the first letter focused on something called perpetual derivatives, or perps. We hear that term a lot in crypto trading circles. Remind us, what exactly are perps?
Right, so perps are essentially these margin contracts, kind of like futures, but with one huge difference. They have no fixed expiration date. They don't just end on a certain day.
And they just keep going.
They keep going. Instead of expiring, they're designed to closely track the spot price of the underlying asset, say Bitcoin or Ether, using this mechanism called a funding rate. It's basically a periodic payment exchanged between traders holding long positions and those holding short positions based on whether the perp price is trading above or below the spot price. This keeps it anchored.
And that lets them mirror the 247 spot markets.
Exactly. And because of that, they've become incredibly popular. They're the most liquid type of crypto-linked futures contract globally by far.
So what points did TDC make to the CFTC about regulating these perps?
They highlighted the potential benefits. They can enhance price discovery. They allow participants to hedge their risk around the clock, which is crucial in crypto. And they avoid the rollover costs and complexities you get with traditional expiring futures.
But they also see risks.
Of course. They stress that for these to operate safely in a regulated U.S. market, you need standard risk controls. Things like robust margin requirements, maybe funding rate caps or circuit breakers to manage extreme volatility, and effective real-time market surveillance systems. They also called for clearer disclosures for customers, making sure people understand the risks around funding rate changes, leverage, and potential liquidity issues. And a key ask is just getting regulatory clarity on how perps should be classified under U.S. law. Are they swaps, futures, something totally new, especially when they're implemented on DeFi platforms?
And their second letter tackled the broader issue of 247 trading and clearing itself. Why is that such a focus?
Right. This is just fundamental to how crypto works. The underlying spot markets trade nonstop globally. Weekends, holidays, doesn't matter.
Right.
So TDC's point is, look, if we could extend this 247 capability to the regulated derivatives markets overseen by the CFTC, it could be really beneficial. Well, it could level the playing field for U.S. platforms and traders who currently have to operate under traditional market hours. It could potentially unlock significant liquidity that currently exists off hours and on weekends. And importantly, it could help reduce that gap risk. You know, those sudden price jumps or drops that can happen over a weekend when traditional futures markets are closed, but the underlying crypto is still trading.
Makes sense. So what were TDC's specific recommendations for actually enabling regulated 2047 trading and clearing? What needs to happen?
They've focused a lot on the operational and technical side. Exchanges and clearinghouses would need incredibly robust, high-availability infrastructure. Think active systems, leveraging cloud tech, geographical redundancy things to absolutely guarantee uptime because there are no breaks.
And risk management has to be automated.
Absolutely essential. You need real-time margin checks, automated liquidation protocols that work instantly with clear alerts, and continuous collateral evaluation because prices are constantly moving, 247. They also argued for updated customer disclosures, ones that specifically spell out the risks of trading and potentially being liquidated during off hours or weekends.
Did they suggest rule changes too?
Yeah, they called for modernizing the rule sets themselves. For example, suggesting the CFTC should consider allowing regulated stablecoins or maybe tokenized fiat as acceptable forms of collateral, which makes sense in a crypto context, and maybe rethinking things like capital reporting timelines that currently assume traditional banking hours. Finally, they really emphasized the need for continuous market surveillance, probably using sophisticated AI and machine learning tools to effectively monitor trading activity around the clock.
Okay, wow. We've covered a lot of ground today, from those specific IRS tax nuances all the way to these big legislative pushes and new regulatory conversations.
It really paints a picture of just incredibly rapid evolution in the first half of 2025, doesn't it? We saw that targeted IRS reporting relief, but also a firm confirmation that core taxpayer responsibilities absolutely remain.
Yeah, and we dove into the SEC's latest thinking on token classification, really hammering that how we test interpretation, focusing on profit expectation and the role of the issuer or promoter.
And then that huge momentum, really, on stablecoin legislation with the Genius Act making serious headway in the Senate. That bipartisan support is key, laying out a detailed federal framework for reserves, issuers, regulation.
Which seems, as we discussed, increasingly aligned with that noticeable shift in tone from the federal banking regulators and those explicit requests from the big traditional banks themselves saying, hey, we want to participate more.
Definitely a confluence of factors there. And finally, we touched on those forward-looking conversations happening at the CFTC. How do we appropriately regulate novel products like perps? How do we adapt our regulated market structures for the reality of 247 trading?
So, I mean, the core theme cutting across all of this, it feels like a definite, if sometimes messy, move towards establishing clearer regulatory frameworks for digital assets in the U.S. It's happening across multiple agencies. Congress is involved. But the direction seems to be towards finding ways to integrate these assets more formally into the financial system.
Yeah, driven by a mix of bipartisan legislative effort and evolving agency perspectives, maybe learning from the past few years.
But while more clarity is emerging, it's obvious the landscape is still very much under construction, right? Highly dynamic.
Absolutely. Things are still changing fast.
So maybe a final thought for you, the listener, to mull over. Consider how this real push for U.S. federal regulatory clarity, especially seeing something like a Genius Act get this far, combined with the banking sector's renewed interest, how might that truly position the U.S. to lead global stablecoin innovation? How does that stack up against, say, the EU, which already has MiCA in place? And ultimately, what could that leadership, or lack thereof, mean for the future, the enduring role of the U.S. dollar in an increasingly digital global economy? Definitely something to think about.